Today's lesson, we're going to focus on what we call the contestability period. All life insurance contracts that are issued in Canada automatically come with what we call a 2-year contestability period. The word contestability basically means that from the date of the application, from the date of the actual policy being issued, for a period of 2 years, the insurance company has the right to contest if in the event that they find something, okay, that would be material misrepresentation of some sort. They have the right within that 2-year period of time to actually contest the policy. So, for example, if you in fact died during that contestability period, and they discover upon you dying that in actual fact there was some material misrepresentation at the time of application. So, for example, you said that you were a non-smoker, in actual fact you were a smoker, for example. Well, obviously that's material enough that had they known, they would have never issued that particular policy for you. So during that contestability period, during that period, if they find certain things that may in fact alter their decision, they could in fact simply void that contract, which to terminate that contract, because it is material misrepresentation. Now, it isn't just only when you die. They could actually find some information during that 2-year period of time. You're still very much alive. In other words, a report comes in from your doctor, it's delayed for whatever reason, and finally they get the report, and the doctor now reports a certain amount of condition that you have, and we now come back and you say, we discovered the following thing, okay? It's that we have now recognized the fact that there has been a problem here, and so therefore, because we have that 2-year sort of window where we could escape the liability, we're going to basically now void that particular contract, or maybe alter the contract. In other words, it's not necessarily to be void, but they could say, okay, we're not going to honor the original contract, we're going to change the contract to something else. So a common one, for example, is a disability claim. When an individual puts in a disability claim, they tell us that they were a manager. In actual fact, they were not a manager. There were different classifications. So again, within that 2-year period of time, we have the right to go back and change that contract. So the first 2 years, it is a contestable type of contract. Whether you're alive or whether you're dead, they could in fact contest. And if they find that there was a material misrepresentation, they could in fact void that contract. Once the 2 years are up, it's what we call the incontestable period. So at that point, the contestable period becomes now incontestable in that after the 2 years, they really can't come back to you on that. However, if you remember in a previous lesson, we talked about 3 big ones, which was fraud, forgery, and theft. And we basically said those 3 go beyond the contestability period. Everything else, they have to find it out within that contestability. But those 3 there is no statute of limitation actually on that. The other thing to remember when we talk about the contestability is what we call replacement. At some point, you're going to find that you're going to probably have to replace an old insurance policy. There's certainly nothing illegal about replacing a policy, again, if done properly. There are 2 kinds of replacements, and you need to know both of them: twisting and churning. So twisting is basically where you, in fact, are basically replacing a policy that from one company with a different insurance company. So if you, for example, are if you're a Transamerica agent and you go to your client's got a Manulife contract, then you convince that individual to drop their Manulife policy and in fact buy your policy, Transamerica policy. That is called twisting. So therefore, you've actually changed it to a different insurance company. Churning, on the other hand, you're a Transamerica agent. You go and your client has a Transamerica policy. You convince them to drop that the old Transamerica and buy a brand new Transamerica. That's churning. So basically, churning is internal replacement. Twisting is really basically externally replacement. Again, nothing illegal here, except that one of the big things that you have to remember is that once you replace a policy, that 2-year contestability starts all over again. So once again, it could be a situation where you've issued a brand new policy, you've canceled the old policy, you die within that period of time, and they discover something. So had they known, they would have never issued that new policy, and all of a sudden you're out. The coverage of the family's health, that coverage of the estate's health, that coverage. So one of the things that's to be very, very careful about in replacing an insurance policy is that contestability period starts all over again. And also remember that, again, in the previous lesson, the replacing a policy, also the suicide clause starts all over again. So again, if your client actually commits suicide within that 2 years, the new policy won't pay out. So therefore, one of the reasons why you buy Arizona Mission Insurance basically is to cover you for situations like that, like this here. So therefore, make absolutely sure that when you're doing a replacement of some sort, that you do it right. There is what they call a Form 1 or disclosure form that's available by all insurance companies, where you in fact in disclosing to your client all the provisions. Here's what you have now. Here's what I'm proposing. These are the reasons why they've agreed to it. So therefore, everybody's on board on this. So therefore, you escape being liable for any situation that may come up in the future. So please, once again, look over the definition of contestability and contestability. Look over the definitions for replacement, both on twisting and churning, and how that impacts the contestability period.